What if I told you the US dollar could become the next financial crisis? And Singaporeans are quietly getting hit. Yes, America's $36 trillion debt is not just an American problem. It could shake the US dollar, US bonds, and even your investments here in Singapore. Stay till the end, because I'll break down how this could impact your money, your job, and how to protect your portfolio, even in a recession or stagflation. Welcome back to Wealth for You. If you want honest, no-fluff money insights made simple, subscribe now and like this video so the YouTube algorithm shares this with more people who need to hear it. Let's dive in. Part 1. U.S. Debt and Trade War. So here's the backdrop. The United States is now carrying a record $36 trillion in national debt. Yes, trillion with a T. And between 2024 and 2025, about one-third of that debt, that's around $12 trillion, needs to be refinanced. But there's a major problem. Interest rates are sky high. Imagine if your HDB loan was 2% before, and now you're being asked to refinance at 5%. That's exactly what's happening to the U.S. government, except their loan is in the trillions. Now add another layer of chaos. Donald Trump is back. And so are his aggressive trade war tactics. He's targeting not just China, but over 40 countries in a push to secure better deals for the U.S. And here's the twist. Trump reportedly wants to fire Jerome Powell, the current Federal Reserve chair, because Powell refuses to cut interest rates. Trump wants cheap borrowing to solve the debt crisis, but Powell wants to keep rates high to fight inflation. So you've got a massive debt, sky-high borrowing costs, political tension at the top, and rising global trade risks. That's why the markets are nervous, and why Singapore investors should start paying attention. Part 2. Will the US dollar and US Treasuries collapse? So here's the million-dollar question. Is the US dollar going to collapse? And what about US bonds? Those supposedly safe investments? Let me tell you a story that's unfolding right now behind the scenes. For decades, the US dollar and US Treasury bonds have been the backbone of the global financial system. Think of them like the blue chips of currencies and government debt. Reliable, trusted, used by almost every central bank on the planet. In fact, about 88% of global trade is still done in US dollars, and 58% of the world's foreign reserves also held in USD. It's huge. Even alternatives like China's RMB, the euro, or even gold, none of them come close in terms of scale, liquidity, and global trust. But here's where the cracks are starting to show. Behind the scenes, investor confidence is wobbling. You're seeing bond prices fall and yields shoot up. Big players like China and Japan, once the largest holders of US bonds, are now slowly reducing their exposure. Why? Because they're worried. Worried that America's debt is spiraling, that politics is too unstable, and that the Federal Reserve is under pressure to help fund government spending. If things get worse, if demand dries up, the U.S. government may have to do the one thing every investor fears: print more money to buy its own debt. That might keep the system running, but at a cost. It would flood the world with more U.S. dollars, and that devalues the currency, slowly but surely. So will the U.S. dollar collapse tomorrow? No. It's not an overnight event. But in a worst-case scenario, where confidence keeps dropping and more countries start to trade in their own currencies instead of USD, we could see the dollar gradually lose its global dominance, especially in regional trade deals where trust in the US is no longer a given. And if that happens, it won't just affect Wall Street. It will shake up the entire global economy, and yes, that includes us here in Singapore. Part 3. What happens to US assets? Now, let's delve into what all this means for U.S. assets, specifically U.S. stocks and bonds. U.S. stocks and bonds. Positive outlook. Despite recent turbulence, the US remains home to some of the world's most influential and profitable companies. Think Microsoft, Apple, and Google. These tech giants continue to demonstrate robust earnings and maintain leadership in areas like artificial intelligence and cloud computing. Morgan Stanley has recently turned bullish on US stocks, citing signs of market stabilization and improving growth conditions. They project the S&P 500 could reach 6,500 by mid-2026, with a bullish scenario of 7,200. Factors contributing to this outlook include anticipated Federal Reserve rate cuts in 2026 and AI-driven efficiency gains. U.S. stocks and bonds. Negative outlook. However, the short-term picture is less rosy. As of May 23, 2025, the Nasdaq Composite Index has declined approximately 3.4% year-to-date. Simultaneously, the US Dollar Index, or DXY, has dropped about 8.8% since the beginning of the year. For Singaporean investors, this dual decline means that investments in US assets have been hit by both falling stock prices and unfavorable currency exchange rates. For instance, if you invested in the Invesco QQQ Trust, or QQQ, which tracks major U.S. tech stocks, your returns would be negatively impacted by both the 3.4% drop in the Nasdaq and the 8.8% depreciation of the U.S. dollar against the Singapore dollar. Moreover, recent policy decisions have added to market volatility. President Trump's threats to impose 50% tariffs on the European Union and 25% tariffs on Apple iPhones manufactured outside the U.S. have unsettled investors, leading to a sell-off in U.S. stocks and bonds. So, what does this mean for Singaporean investors? While the U.S. continues to be a hub of innovation with strong long-term prospects, current market conditions are challenging. Investors need to be mindful of both market and currency risks. It's essential to assess whether current dips represent buying opportunities or signals to exercise caution. Part 4. What does this mean for the world? So, what happens if U.S. bond yields stay high and the government keeps printing money to cover its debt? Let's start globally. When Americans face higher borrowing costs, they spend less. That means less demand for exports from Asia, including countries like Singapore, Malaysia, and China. Slower U.S. consumption can drag down GDP across export-dependent economies. Also, with U.S. interest rates staying elevated, global interest rates remain high too. Borrowing becomes more expensive everywhere, for governments, businesses, and consumers. Back in the U.S., the pain is more direct. Mortgage rates shoot up, making homes harder to afford. And as businesses struggle to borrow, they may cut hiring or even lay off workers. What starts as a debt problem in Washington can quietly ripple across the world. And yes, it could land right here in Asia too. Part 5. What about everyday Singaporeans? So what does all this mean for the average Singaporean? If the world enters a period of stagflation, that's when the economy slows but prices keep rising. Or if a global recession hits, here's what we might feel at home. Imported goods like groceries, electronics, and petrol may get more expensive, especially if the US dollar weakens and global supply chains are disrupted. Singaporean exporters, from tech to precision engineering, may face slower orders as demand from the U.S. and other big economies dries up. Jobs in sectors like shipping, manufacturing, and finance could face pressure if global trade slows down and companies tighten their budgets. But, and this is important, don't panic. These risks don't mean doom is guaranteed. It simply means we should prepare smartly. Part 6. What should Singapore investors do? So, how should you position yourself if all this uncertainty unfolds? Here are 4 smart moves Singapore investors can consider. 1. Stay defensive. Focus on companies with stable, predictable income, even in a downturn. A good example? REITs that own retail malls in Singapore. Think about it. Even during a recession, people still head to the mall for chicken rice, kopi, or $5 food court meals. Malls like Causeway Point or North Point still collect rent, and you still collect dividends. These are the kinds of assets that can ride out the storm better than high-growth, high-risk tech stocks. 2. Hold strong currencies. Keep the bulk of your savings and investments in SGD, not USD. Why? Because the Singapore dollar is one of the strongest, most stable currencies in the world. It's backed by robust reserves and managed against a basket of currencies, not just the US dollar. So even if the USD weakens, the SGD tends to hold up better and protect your purchasing power. 3. Be cautious with US assets. If you own stocks or REITs that earn revenue in USD, you're exposed to foreign exchange or FX risk. Even if the stock price stays the same, a weaker USD means you get less value when converting back to SGD. Instead, consider investing in companies that earn in SGD or RMB, like Singapore REITs or China consumer brands that are expanding globally. They offer better currency protection and may hold up better in an uncertain world. 4. It's not too late to rotate. Yes, you might be sitting on some paper losses if you're holding US assets, but ask yourself, would you rather take a small hit now or risk bigger losses later? Rotating to more stable, income-generating assets could give you peace of mind and cash flow, especially if the global economy slows further. Bottom line, be smart, stay steady, and remember, Singapore investors do have options to protect and grow their wealth. Final thoughts. So to wrap it all up, U.S. assets are clearly under pressure, and the U.S. dollar isn't as dominant as it used to be. We may not see a sudden collapse, but what we're witnessing is a slow and steady shift in the global financial system. For Singaporeans, this is a timely reminder. Stay alert, stay diversified, and don't put all your eggs in a US-shaped basket, because sometimes the best place to be is exactly where you are, home, in a strong and stable market like Singapore. If you found this video helpful, don't forget to like, subscribe to Wealth for You, and comment below. Do you still invest in US stocks? We'll continue bringing you more money insights, explained in plain English, so you can invest smarter, not harder. Disclaimer: this video is for educational and informational purposes only. It does not constitute financial advice. Always do your own research or speak to a licensed financial advisor before making any investment decisions. Take care, stay safe, and huada, bye-bye.